Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Karen Rands, who wrote Inside Secrets to Angel Investing. Karen, thank you for joining us.
Thank you very much, Hall. Delighted to be on your show today.
Great. So what was your background before you started investing in early stage companies?
Well, I was in the corporate world with IBM, and my last job there was called the Complex Opportunity Business Manager. And my task was to evaluate companies and provide IBM, basically champion for them, IBM resources and capital to prepare that company and sort of validate them so they could go out and get what we pretty much called at the time venture capital, so they could come back and spend it with IBM. And then when I left IBM shortly after that to go help one of the companies that I've been working with go to market and raise capital, I discovered this world of angel investors through the organization I ended up taking over, the Network of Business Angels and Investors, which is an angel group here in Atlanta. And I discovered this whole new world that made sense to me. I really had never been exposed to it as a person that was mid-level manager in corporate America. And so it was very exciting. And as a result, to be a part of that group, I co-invested with other investors with companies that were coming through the NBA&I platform.
Right. So you've seen a lot of angel investing over the years, and there's a lot of new people coming into it every day. What's your advice for those starting angel investing today, and in particular in early stage funding?
Well, I'm going to be self-serving here, Hal, and say they should go get my book, Inside Secrets to Angel Investing, because the nice thing about it, and I think we'll get into this a little bit more within this segment, but there's really every different level for individual investor to participate at whatever risk tolerance they have, investment with discretionary income or discretionary funds they have to invest. There's just so many ways to participate, from the different types of crowdfunding all the way up to the growth companies. And then also there's more and more funds coming in to play in the marketplace that they can put their money in almost like they would a mutual fund and have the value of the science and the data and the due diligence teams that these funds have, that they can be like they're part of a venture capital fund, but be at an angel stage. So there's just so many ways for them to participate. I think, my whole idea of compassionate capitalism is to get folks to start thinking about adding that to their portfolio the way they think about adding real estate to their portfolio.
So how do you see the angel investing world evolving? You've been studying it for a while, and this book took some time to put together, and you've seen the angel world moving forward. In what way is it evolving or changing?
Well, I think part of it is this idea of angel investing, those two words coming together, they sort of, by their nature and how it got started many, many, many years ago in the United States, was always very, very exclusive type of group. It was geographically limited, income limited, time limited, the way most of the angel groups were set up, or access to deals, or how you would go about evaluating deal, even knowing that you could do that outside of your scope of what your wealth manager or financial planner might propose. And so I think the way that's evolving is that angel investing as a definition of a person has evolved into more of a state of types of investments you make. And then for my previous answer, that runs the whole spectrum of stages and industries and the progress of a company for whatever the risk profile is for an investor to participate in. So I think it's changing the kind of the definition of angel investing at its core.
And certainly there's so many more choices too out there. There's so many more types of deals and deal structures. It used to be you just put your money in and hope for the best, but now you have revenue-based funding, royalty-based funding, venture debt, and you have various other models that are out there like syndicates and those type of things. What do you think is going to be the biggest change for angel investors in the coming years? It seems like angels used to be the only ones out there at this stage, but now it seems like there's a lot of players out there, micro VC funds, VCs that actually invest in pre-revenue deals, incubators, accelerators. There's so many more choices out there. Where do you think the angel is going to end up in all of this?
Well, really, my mission and my thing that I focus a lot of my attention on right now is spreading the word that people can participate in all those different ways. Before, really, when you had the angel groups, and even with the groups, both the group that I used to run and the groups you've been involved in, it was always really as much a time commitment as it was a money commitment. And now you have, because of the different ways and means, there's really something for everybody. And we just need to have more everybody's, right? Because the market has done a good job of creating products that have a different various risk profiles for the different investors. There's all kinds of groups that now are specializing in certain sectors of the marketplace. So you can invest in the sector in the industry that you know the best. And it's just a matter of folks becoming aware of all of those options and that they can participate and not immediately shutting down that they've predefined what angel investing is and that they're and excluding themselves from that process because they just don't know that there's all of these options for creating wealth out there.
Right. Well, one of the arguments I hear in angel groups is, should we be generalists and take every deal that comes in the door, or should we be specialists and pick a much more narrow investment thesis, where some people say, we'll take tech, healthcare, consumer product goods, and just about everything that's out there. But then now you have a lot of deal flow to go through. Others take a much more narrow focus, say fintech or medical device, and then they go for a more in-depth knowledge on it, but then you have less deals. You have to look further afield for them. What do you think is the best way of approaching this?
For individuals, I kind of lead towards the Warren Buffett model of invest in what you know. Now, one of the things I cover in the book is that you can't go solo on an investment. You need to spread the risk out with other investors. You need to spread the knowledge out and the dissecting a deal with other investors. So either form a team or get involved in a group that aligns with your focus area. And then from an angel group standpoint, it really depends on your membership. And I think that so many of them start up, like in Atlanta, I could speak to one of our organizations, Atlanta Technology Angels. And they were very, very specific back 10, 15 years ago. It was easier to identify it. Now so much involves technology in the delivery of whatever it is into the marketplace, that they've become much more generalists, right? Because whether it's a consumer product, have tech in them. You have online environments that have tech, fintech, you know what I mean? There's all kinds of things medical tech, there's all kinds of things that have tech in it. And so they've now started looking more towards the parameters of a deal and whether this deal has a marketplace, has a pathway to an exit, and some of the basics of what you look at when you're trying to truly evaluate one deal over another deal.
I liked in particular what you wrote in chapter 3 about when you invest in a startup, you're basically getting married. And in fact, I looked that up one year and found that in many cases, investors were in a deal longer than they were in their marriage based on national averages. And I thought, wow, what's your take on that?
Yeah. Well, I tried to bring a little humor to the process because one of the things that I think with new investors coming into the marketplace, particularly with the crowdfunding options that you have you almost have like one of these swipe left, swipe right type of approaches to looking at deals. And it is so much more than that. It's not just the introduction and falling in love based on the looks of a deal. You have to begin dating in the courtship, because it's in the courtship that you do the due diligence. And that's how I compare it, because you need to understand the background of the entrepreneurs. You need to understand their marketplace, and do they understand it? In the book, we give a whole list of questions you can ask entrepreneurs if it's not covered in their documents. But you have to go through that to decide if you're compatible, because depending on this stage, if you're a totally passive investor, then it's a higher risk because you don't have much control over it. But there's also this idea of being active. A lot of early stage, seed stage investors want to be active in the deal. And I have this term called execs with checks that we use, where sometimes an early stage company only has the guy that invented it and maybe one or two others, and they need more of a team. So we look for somebody that not only has the money, but is aligned with the vision the entrepreneur has, and there's a mutual respect for the common goals and the mission of the company. And so regardless of whether you're going to be truly entrenched and married in the deal for hopefully not 10 years, or you're going to be somebody that's going to spread a lot of money all over the place and invest small amounts of money in a large number of companies, you still have to go beyond the date. You got to get into that courtship, or you're basically, you might as well go to Vegas and throw some money on the table and toss some dice, because it's more than just glamour show or a beauty contest when it comes to putting your money to work in entrepreneurism.
So when I started angel investing, it was just people coming together to invest, and they were getting help elsewhere. But today there's incubator or accelerator on every corner. And some angel groups have adopted that into their model, where they were an angel incubator combination, and that you invest for funding, but you can take additional equity for the time you invest in mentoring, which was one of the complaints in the early model, is you really didn't get much compensation for the time you spent on it. But now with an angel incubator model, you do. What's your take on that?
Oh, I've always been, that's kind of harkens back to the exec with a check concept, but I think it's very valid if somebody is spending their time, their knowledge, their resources, and their money, which by my definition is compassionate capitalism, then they deserve to be compensated for that. And if the entrepreneur doesn't have the money to pay for them, then that's how they create value in their company, and they bring those people on as an equity investment. What you want to avoid is where an investor puts money in and then turns around and pays themselves because they're going to take on an executive role in the company. A lot of the investors in my group early on, when we were starting out, and a number of them in ATA, would get involved as an interim CFO or interim chief marketing person or some type of operations or whatever it might be. And they would come in with the goal to build that company up so that there was enough revenue to replace themselves with a paid person. And then they would help to find that paid person to come in. But in that meantime, they'd pre-agreed the amount of equity they would get that would be co-investing with the amount of money that they put in. So the money could go directly to getting to a point of generating revenue or generating more revenue, getting to profit because of the money that was put in and the time just to help protect their own investment in that. And then it also leads, I always say, if you are somebody that's not really experienced and you know somebody that's an experienced angel investor and they're taking one of those lead roles in a company, well, that's a good company for you to stay in touch with, because if you value that lead investor's opinion and experience, then you can tag along with that investment and help that company succeed even faster with the experience of your colleague in there.
Well, that's great. I remember last time I was talking to some angel groups a few years ago, crowdfunding has started rising up and being a bigger factor. And a lot of the angels looked at crowdfunding as being a challenge. These guys are going to lose their money, and they don't know what they're doing, and they're not professional investors and so forth. What impact do you think crowdfunding has been on angel investing?
Hal, it's interesting that you asked that question, because I know when they were first coming out with the Jobs Act, at least where in my region, they were very fearful and of the crowdfunding. One, because the first one that came out was for 506C, that you could general solicit, but that was the one where you had to prove you were an investor. And so most of the existing angel investors desired to maintain their privacy and really resisted that particular model. And then as the other platforms came out, they viewed Reg CF as where you get the difference between accredited and unaccredited dissipating, as they didn't want to have to be co-investing alongside these, what they considered inexperienced or potentially dangerous investors, because they would have a vote in the direction of the company, even if they were just crowdfunding investors with putting in a tenth of what maybe the angel investor has been. So I think now that the dust is somewhat settled and you've seen a lot of, I guess, revelations that some of the companies that were early receivers or benefactors of the reward-based crowdfunding, those companies went on and got a lot of venture capital money and bypassed the whole angel investor step. So there's now sort of this pockets of angel groups recognizing that you can co-invest or use the various crowdfunding platforms as a way to maybe take that company that has stalled because they haven't been able to get their next round of capital from a VC marketplace, and they can get access to capital from the general marketplace, the crowd finance marketplace. Take away the term crowdfunding if it's got a negative connotation to it. But getting investors from the crowd as they grow their brand, as they launch new products, there's access to additional capital that they may not have been able to. And I'm hoping that with this idea of compassionate capitalism, with the things that I'm trying to do to bring more of those investors into the marketplace, that's smart money, that the angel groups will look to it as a way to jumpstart those entrepreneurs that may have become the lifestyle business, or where they're getting their return through payroll rather than an exit, or as one of Jake, your prior from Seraph Angels mentioned on his show, the zombies of the entrepreneur world that are just sort of existing without no real end in sight of when they're going to create a value proposition to create an exit for the investors. So crowdfunding, I think, is a great complement to traditional angel investors, because it's very hard to get pure seed stage, particularly on companies that need a lot of money, without them going through either something that gets it to a point that it's angel investor, their MVP is done, and so it's angel investor group ready, or to that next level beyond the angel investor group that bridges the gap to the next round of institutional funding through the crowd finance platforms.
Well, there's many sectors, subsectors, and applications out there for angels to pursue. If you had to pick 2 or 3 as good immediate opportunities, which ones do you think are a good fit for the angel investor today?
Well, that goes back to what they know and what their expectation of an internal rate of return or their ROI could be, because so often I saw investors move towards a mobile and software and things that had might have a large upfront development cost, but when it came to deployment into the marketplace, there really wasn't a cost of goods that was associated with it that would eat up a lot of the revenue or eat up the amount of investment capital that was put into it. And so that became sort of like the preferred model. But now we see, because of fintech and medtech and some of the consumer products and some of the crowdfunding platforms that have enabled consumer products to get to market effectively, have some options with investors and understanding how to integrate debt finance in there, that they can embrace something that might have a larger cost of goods or go to market than, say, a software product, because they're different models for those. The thing we find out with software products now, particularly mobile apps, is that there's such a preponderance of noise of what's available out there, that the difference is that you have to really ramp up on the marketing and branding awareness and spending money on that. And so I think some companies go flat because they've not anticipated how hard it's going to be to create national awareness about their product, because they're only using social media or something like that, and they haven't budgeted for the amount of marketing and advertising it's going to take to grow their brand. Whereas consumer products companies know they have to do that. And so they anticipate that. So but they can do a lot of their other types of financing through alternative financing. These other rates and royalty financing becomes something that consumer products can tap into as a addition to, say, traditional angel investing.
Well, that's a good point. Well, in the last few minutes that we have here today, what else should we cover that we haven't?
I think one of the things I think so many times when I'm out there talking about this idea of compassionate capitalism, the idea of investing in the passion of an entrepreneur so that you can bring innovation to the market, create jobs, and create wealth, that you can not assume all the risk of being an entrepreneur. A lot of times people go through life and they climb the corporate ladder and they keep thinking, oh, am I ever going to be an entrepreneur? I want to be an entrepreneur. I've always wanted to be an entrepreneur. But they've developed this lifestyle that they have, and they worry about the risk of sacrificing all of that to go become an entrepreneur. And they don't have to. They can become an investor in an entrepreneur. And if they go through the right mechanisms and they build their own risk portfolio profile, they can adopt that as an asset class. And with that, because there's so many options, it really is something that I hope that people will look at, that if they're making hundreds of thousands of dollars a year in their job or running their own company, that it just makes sense to carve out some percentage, 10% of your investment portfolio strategy, and start looking at how to put that into entrepreneur endeavors and just get in the game. because it's extremely rewarding. Emotionally, it's rewarding, and financially, it's rewarding.
Well, that's good advice. So how best for listeners to get back in touch with you?
Well, my main website is my name, Karen Rands, KarenRands @.co or KarenRands.co. And within that, I have a page on my book. You can also go to it as Inside Secrets to angelinvesting.com. You can get excerpts of the 44 secrets that are in there, 12 of them. There's also a first chapter that you can get. And then once you buy the book, you can get access to the resource portal that gives you a plethora of tools to use as you go through your learning curve on this. And all my social media is available at either one of those sites you get to. You can get to me on Twitter and Facebook and Instagram and all those things, LinkedIn.
Well, that's great. Well, we'll put those in the show notes so people can get back in touch with you. I want to thank you for taking time to share your book with us today and hope to have you back for more details later. Thank you so much for your time.
Thank you so much, Hal. And I've enjoyed learning more about all you're doing with Investor Connect as well. So I'm excited to be connected with you, and thank you for the opportunity.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.